Hello everyone. Today, we will take an in-depth look at Tesla inverse leveraged ETFs. This lecture is not simply an introduction to a product, but a step-by-step explanation of the structure, risks, and strategies of these ETFs. First, let me give you an important warning. Leveraged ETFs and inverse ETFs are completely different from ordinary stocks. They are designed to maximize daily performance, and if held for a long period, can result in significant losses. Let's start with the basic concept of ETFs. An ETF is a fund that bundles multiple assets but trades like a stock. A leveraged ETF amplifies the daily volatility of an index by 2 or 3 times. If the index rises by 1%, the ETF rises by 2-3%. If it falls, the losses are also multiplied. An inverse ETF moves in the opposite direction of the index. If the index rises by 1%, the ETF falls by 1%. An inverse leveraged ETF combines these two concepts. If the index rises by 1% in a day, a 2x inverse ETF falls by 2%. There are also various ETFs based on Tesla, TSLQ, TSLZ, TSLS, and others are designed for short-term directional bets. Now let's look at the risks. The key feature of leveraged and inverse ETFs is the daily reset. Because leverage is readjusted every day, the problem of compounding decay occurs. Losses can accumulate even in a sideways market. For example, even if Tesla's stock price returns to its original level, a 2x ETF can still show a loss. This is the effect of compounding decay. A 3x leveraged ETF is even more dangerous. If the underlying falls more than 33% in a single day, the fund can collapse. In addition, management fees are high. The exposure is concentrated on a single stock, and there are derivative-related risks. Ultimately, they are not suitable for long-term investment. Why Tesla? Because Tesla is one of the most volatile stocks in the market. Optimistic factors: Musk's share buybacks, robotaxis, FSD, Optimus robots. Pessimistic factors: declining sales, intensified competition, delayed technology. In other words, a Tesla ETF is not an investment in the company's long-term value, but a bet on the market's daily reaction to news and events. Let's look at usage strategies. First, short-term speculative trading. If earnings are expected to disappoint, or if a technology announcement may fall short of expectations, an investor can take a short-term position through an inverse ETF. Second, portfolio hedging. This means holding Tesla stock long-term, but investing a small amount to prepare for short-term declines. In this case, a 1x inverse ETF may be more appropriate. However, the allocation must always be kept small. To summarize, Tesla inverse leveraged ETFs are purely tools for short-term trading. Long-term holding is risky. The conclusion is clear. These products can be used for speculation, but the risk of total capital loss is very real. You must study thoroughly and consult with experts before approaching them. Let me emphasize again, these should only be used for hedging with a very small amount you can afford to lose entirely, and only for short-term trades when the stock price shows signs of overheating.